Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about retiring abroad with an RRSP. So if you've lived in Canada, you've built up your RRSP, and now you've decided to retire outside of Canada. But what do you do with that RRSP? Can you roll it to a RRIF? Can you hold on to it? Do you have to transfer it to the country that you're moving to? We're going to cover all of that and more in this video. So contrary to what most of you believe, when you leave Canada with an RRSP or a RRIF, you are not required to deregister your RRSP or RRIF. Okay, so you don't have to deregister, move it to whatever country you're relocating to. You can keep that RRSP or RRIF in Canada and essentially leave it as it is. Now, there's obviously a few rules around that, which we'll go through in this video, but when you leave Canada, you could go to any other country, leave your RRSP here, or your RRIF, keep it building for you, tax deferred, and then pull it out down the road in retirement in whatever country you're in. Now, we'll go through the tax consequences of that, but you do not have to deregister the RRSP when you leave Canada. Now, when you relocate abroad, the majority, 99% of countries, will view your RRSP as a tax deferred investment vehicle. Okay, so they will not tax you on an annual basis on any growth in that account. Okay. There are a few countries, I'm not going to list them here, but there's a very small few countries that will actually tax you on annual earnings. Most of you will never go there and retire abroad there, so I'm not going to go through each country individually. But general rule, if you relocate and retire abroad, you want to dig into that country, Canada, what that means. So in our videos, because there's way too many countries, we could do videos every day for years on different countries and different strategies and options and taxes and that kind of stuff. We're not going to break down each country individually in our videos. There's too much to know though. So we're going to use general terms. So in general, your RRSPs will grow tax deferred. So for 99% of you, there are a few countries, again, that will not view your RRSP as a tax deferred account, meaning that, if you earn, let's say, $1,000 in your RRSP, or your RRSP grows by $1,000 in the year, and you're living abroad in certain countries, they may say, look, that $1,000 is actually earned income in that year and taxed you accordingly. Much like if you're in Canada and you're a dual citizen or a US citizen and you hold a TFSA account, right? The US sees that as not a tax-free or tax-deferred account, and they actually tax you on it in the state. So much the same there, but just be aware of that. So the majority of countries will view the RRSP as a tax-deferred account and will not tax you on any growth on an annual basis. So one thing to keep in mind is if you're leaving the country and you want to make one last RRSP contribution, so let's say you leave any time from January 1st to December 31st, you leave Canada, you go to retire abroad or move abroad, you are able to make a last RRSP contribution for that tax year up until 60 days after. So the regular RRSP deadline, which is March 1st most years, you can still make that RRSP contribution for your previous year's tax refund. Okay, so let's say you left the country, retired abroad, moved abroad September 1st. You can still make an RRSP contribution for your Canadian taxes to get the deduction up until 60 days after year end. So again, most time it's March 1st for you. So even though you've left the country, you can still deposit an RRSP later, 60 days past year end, and have that deducted on your previous year's tax return for tax purposes. So just because you've left doesn't mean you can't make that last RRSP contribution. Now, I think one of the biggest conversations that a lot of people look past is when you retire or move abroad. And we've had clients move abroad. We had a client not too long ago move to Australia for work purposes. And, they may only be there for 5, 6, 7 years. But now that they've moved abroad, the financial institution that they're invested with no longer will carry their accounts. Okay. So you have to be aware of that. Even though you can hold your RRSP in Canada here, not all investment firms, not all banks, financial institutions will actually hold your account. Okay, so there's kind of two parts to this. A, they may not hold your account, which means you may have to transfer it to a different financial institution within Canada. Okay, so if you're looking to retire abroad or move abroad, doesn't matter what age you are, check with your financial institution or wherever your investments are held to see if you're able to hold your RRSP there. Okay, we're not going to cover off TFSA non-registered accounts in this video. We'll do that in a future video. But for your RRSP, confirm that, hey, if I move to New Zealand or South America somewhere or, Asia, wherever you're moving to, can you still hold my RRSP? Okay, so that's the first part. The second part to this is, okay, you can hold my RRSP. what are my investment options? Okay, so sometimes, yes, we can hold your RRSP, but you can't do any adjustments in your account. So if you hold ABC fund, that's what you're going to continue to hold. You cannot do any changes within that. Or sometimes for foreigners, they only have a small list of investment options that you can actually invest in. Okay, so before you leave Canada, make sure to check with your financial institution. You don't want to get in a position where you move abroad and then you realize, they can't hold it. Now you're trying to switch investment firms. Most investment firms cannot sign on new clients when you're abroad. They need you here. Some can. We work with some that can, but a lot can't. Okay, so just be aware of that. Check that out. If your financial institution either can't hold your RRSP or is going to have limited or no investment options for you, then you may want to look elsewhere, look at different options, find a better financial institution that can better manage your money. You want to make sure you can still manage your money or have it managed professionally while you're abroad, because you want it to earn. Markets change, things change, the world changes. You want to be able to adjust your account accordingly. So make sure that those accounts are set up before you leave the country in order to do that. So if you're living abroad with a RRSP in Canada and you take a lump sum out of the RRSP, so not RRIF, but your RRSP, you've not converted it to RRIF, whether you're not at that age yet or you just haven't done that yet. If you take a lump sum out of your RRSP or any or withdrawal out of your RRSP, there's going to be a 25% withholding tax. Okay, so be aware of that. Lumps out of there, 25% withholding tax. So just be aware of your overall income, what country you live in, if there's a tax treaty, to make sure that you get a tax credit for that 25% so that you're not losing that at the end of the day. Now, if there is a tax treaty in place, there may be opportunity for less than 25%. It's going to range for most between 15 and 25% withholding tax on that RRSP redemption, okay? So be aware of that. If you're pulling money out of your RRSP living abroad, depends what country you're in, what kind of tax treaties in place. Again, wherever you're moving to, do your due diligence, dig into that, dig into the tax treaty, the tax consequences, how this is all structured. Hire a tax border professional that knows whatever country you're moving to, as well as Canada. If you move into a smaller country, less known country, there's some common ones out there. There's definitely tax professionals that focus on cross-border stuff. If you move into a small country or one that a lot of people aren't going to from Canada, it may be tough to find a professional. So it's going to take a lot of more kind of digging and legwork and time on your end to figure that out. But do your homework. Make sure you understand where you're moving, what the tax consequences are, and figure that stuff out before you go there, not after you arrive. So much like redeeming money out of the RRSP, when you pull money out of your RRIF, if it's a regular payment out of your RRIF, for most countries, there's going to be a withholding tax. Again, tax treaties are going to kind of regulate this. It can be anywhere from 0% up to the 25%. Most fall at 15%, but it can range from that 0 to 25%. Again, every country is different, but most will have a withholding tax. 15 to 25% is going to be the most common number that you see. There will be that withholding tax. Now, again, you may move to a tax-exempt country where there's 0% tax. So there's obviously a benefit to that. Be aware of that. So whatever country you move into, there will be a withholding tax for most of you. Again, there's a small number that have 0%. The tax treaty works out where there's a 0% withholding tax. So what happens if you move to a country where you have a withholding tax on your RRIF redemption, and it's say 15 or 25%, but that's your only income for the year, right? So let's say you move to a country, you pull money out of your RRIF, and there's a 25% withholding tax, but that's your only income for the year. So when you file a tax return in the country that you're living in, there's not going to be, a tax. You're not going to get that 25% back. You're paying more tax than you would if you were living in Canada. And that happens quite often, okay? So let's say you pulled $15,000 out of your RRIF and you had no other taxable income for the year. Maybe you had some cash, whatever it is. That was your only taxable income. Now, $15,000, when you pull that out of the RRIF because you are a foreigner, they're going to withhold, say, in this example, 25%, okay? Well, if you lived in Canada and only had $15,000 of income, you would not be in a 25% tax bracket. In fact, you'd be in retirement essentially close to 0% tax. So you've paid more tax living abroad than if you had stayed in Canada, okay? That's important to know, okay? So if you retire abroad, be aware of withholding tax, right? A withholding tax is what the government CRA withholds at source, okay? Now, most countries will give you a foreign tax credit, okay? So if you move to a country, you do your tax return, they're going to say, look, you owe $10,000 in tax, you've prepaid or you've already paid taxes in Canada of $3,000, so you only owe $7,000 more. But if your income's really low, you may do your tax return and it's you owe $1,000 in tax, but you've prepaid, let's say $3,000 in Canada, that $2,000 is gone, okay? You're not going to get that back. Now, there is a way to apply for this and potentially get that back, or at least have the withholding tax set at a lower number based on your overall lower worldwide income. So they're going to tax it as if you were living in Canada, even though you're living abroad. So if you fall into this category, you want to hire a tax border accountant that really understands this stuff. It's under Section 217. So there's a Section 217 tax filing that you can file to have withholding tax or taxes on your RRIF withdrawals based as if you were a resident. Even though you're a non-resident, it will tax you as if you were a resident, which again, if you have no other income, they're going to tax you much lower and you're not going to lose that spread of withholding tax, okay? So if you fall into this category, whether you're living abroad currently or you're planning to retire abroad with very low income, be aware that Section 217 is probably something you want to dig into and look into. We're not going to cover it any further in this video. You're going to want to hire a cross-border tax professional that understands this, how to file it, and make sure that all the T's are crossed and the I's are dotted. Okay, so make sure you hire a tax professional if you fall into this category, which a lot of you looking to retire abroad is because you're going to have a low income. So if you move to a country that has a 25% withholding tax on your RRIF withdrawals, that's probably going to be more tax than what you're going to owe otherwise. So you might want to consider, again, reaching out to a tax professional, asking about Section 217 to see if it applies to you and how to make sure you're applying for that and filing that tax return every single year. So as mentioned, when you live abroad and you pull money out of your RRSP or your RRIF, there's most likely going to be some sort of withholding tax. And again, that withholding tax, for most countries, you're going to get a tax credit for it. So if let's say you live in Australia, okay? You live in Australia, let's say I don't know what the withholding tax is. Let's say it's 25%, okay? You pull $10,000 out of your RRIF. Canada is going to hold $2,500 of that $10,000. You're going to receive $7,500. When you file your Australian tax return in the year, they're going to say you owe, let's say, $5,000 of tax. You've already paid $2,500 in Canada. You're left due or paying the other $2,500. So there is a tax credit. Again, I'm using Australia as an example. Those numbers are not probably correct, but that's, in general terms, that's how it works. So when you have a withholding tax, most countries will give you a foreign tax credit for that, which will reduce the amount of tax you have to pay in the country you're living in because you've got that tax credit. So that's how it works. Again, don't take my Australia example as a true example and the numbers are right. I'm sure they're not, but that's in general. Doesn't matter what country you go to. If they have a tax treaty, most likely you're going to get a tax credit for any withholding tax on your RRSP or RRIF withdrawal. And as most of you know, there are countries in our world where there's no taxes at all. They're tax-free countries. Now, be aware that there are some, again, not going to list them in this video, but there are some that you could move to and actually start pulling down, again, using Section 217, have lower withholding tax on your RRIF withdrawals. That's your only income. No tax where you're living. There are some tax strategies that you could potentially roll out. Again, we're getting very in-depth and complicated in this. For most of you, you're going to move to a country that there is a withholding tax. You have to pay tax every year there. There should be a foreign tax credit available to you. So just make sure all those numbers are working together. Again, if the withholding tax is higher than the amount of tax you would pay otherwise, look at Section 217. You want to make sure that you're not paying more tax because of this withholding tax than otherwise. And again, a lot of you retire abroad. I know this because you leave it in the comments. A lot of you are looking to retire abroad because it's a lower cost of living. You have a low retirement income. I have a family member that would love to retire abroad just because it's cheaper. It's cheaper to live, which means that you're going to pull less income. But if you're losing 25%, let's say, to withholding tax, you may be losing more than the actual tax you have to pay, okay? So just be aware of that. This has to all come together, right? Financial planning is looking at all the pieces of the pie, making sure it comes together and kind of molds into that pie, okay? You can't have stuff all over the place. The other thing I will say is that a lot of you retire abroad and try and figure all this stuff out when you get there. Okay, you need to do this stuff before you leave. Okay, trying to figure out, the tax consequences and withholding tax and structure and what accounts you're allowed to own and not own, that can't be done once you're abroad. And in fact, sometimes there's a departure tax when you leave Canada. There's all that. Again, we're going to do another video on departure tax, but there's a lot of things to think about when you leave. This video, I'm just covering the RRSP because a lot of you have an RRSP or a RRIF if you leave in retirement, and a lot of you are going to bump up against this. So I think you need to know this information. Again, we'll leave some links below as far as tax treaties, withholding taxes, all that kind of stuff. Most of the countries will be listed there. Again, when you leave Canada, whatever country you move into, do your research, do your digging. There's a lot of information online, a lot of good information online. There's a lot of expats that are living in other countries that maybe have blogs, and share their wisdom, their experience, their strategies that they've used successfully. Dig into those, read into those. It's the internet, be careful what you read, but there are a lot of good content out there. So check into that before you just jump ship and hopefully it all works out, because it probably won't. So hopefully this video helps you out with your RRSP, your RRIF, and just how that works when you leave Canada. Again, we did a video earlier this week on OAS and CPP. We wanted to do one on RRSP and RRIFs. We're going to do more locked-in accounts, departure tax, all these different things that really you will bump up against when you leave Canada that are very important to understand and do your due diligence on before you leave the country. So hopefully this helped you. Again, we really do appreciate all of you watching our videos. If you enjoy these, make sure to hit the subscribe button. Still, over 50% of you watching aren't part of the channel. Hit the subscribe. If you enjoy these, hit the thumbs up. It really does help get these videos out. The YouTube algorithm is a very unique thing, and the more likes, the more comments, the more subscribers, it does help get these videos out. And more people need to hear this content, whether it's this video or other videos that we've done, whether it's tax-free, RRSP, tax savings, retirement planning. Again, we cover on this channel tax, estate, financial, retirement planning, just how to better position yourself for retirement so that you don't make the common mistakes that we see every single day. So we're trying to help Canadians, whether you're in Canada or abroad, not kind of hit these bumps in the road that we see too many people make that are avoidable. So again, thanks for watching this video. We'll see you in the next one.